Do you have some experience with the Iron Condor strategy? If you're like most traders, you're convinced that this strategy holds a tremendous amount of potential to create consistent results and real wealth in your portfolio. But if you're also like most traders that I talk to, you're unhappy with your results. Up 5 months in a row, and then the next cycle takes all of those profits. It's pretty frustrating, isn't it? Yet it doesn't have to be like that. You just need some stronger skills to improve your offense and defense. Let me explain.
Now, if you're watching this video, I'm hoping that you're at least a little bit familiar with the Iron Condor strategy, as well as the advantages and the challenges that this strategy has. It's a great option strategy that I've been playing through just about everything that we've seen over the past 10 years. And it's a relatively simple concept that everyone understands, where we can place credit spread positions above resistance and below support, and the price has a huge range that I can trade within until expiration. And we can trade these with monthly or weekly option positions as well. But because it's a simple strategy to understand, it also entices traders to jump in before really being prepared to manage the trade. So let's break it down to offense and defense, like a football team. We have to have a complete game plan in place before we place that trade. And there are a couple of things that you need to know before you take the field with this strategy. Let's discuss offense first. One of the first things that you'll hear the experts talk about is that iron condors are great for flat markets. And they are, after you have placed the trade. One of the biggest traps that I see traders fall for is a market that's been flat for a while, trading within a range, so they get excited and slap an iron condor in that chart, only to get run over on the breakout from that range. Range contraction leads to range expansion, right? They didn't have the right game plan if all they are looking for is flat markets. And then the next thing I hear is that experts talking about high implied volatility is good for iron condors. How selling iron condors into high implied volatility will create great iron condor conditions. Well, let's take a look. If we go back and look at that practice over the past couple of years, we can see that every time we have high implied volatility relative to the rest of the chart, this tends to spawn a huge rally that would run over any bear call spread that you put in place, or the upper leg of that iron condor. We can see this over and over again. Every single spike in implied volatility, which supposedly creates these great iron condor conditions, leads to a big rally. And it's not just the past couple of years. It really goes well back before that. So we have to question that supposed best practice. The point here is that there's more to it than just slapping on an iron condor during flat markets or high implied volatility. We need a better edge than that to enter the trade. So now let's look at the defensive side of the team. Placing an iron condor trade is the same thing as kicking the ball off to the other team in football. In this case, the other team is the market. You've got your credit in your account already, and you want to defend that credit or keep as much as possible. And think of those short options that you've sold as the goal line that the market has to score on to cause a loss against your position. And in the case of the iron condor, we've got not one, but two goal lines that we have to defend. The call spreads to the upside and the put spreads to the downside. Most retail traders that start trading this strategy put all of their effort into the offense without really thinking through what actions they will take should the trade not work out. And what we've found over the years is that it really requires a layered approach to defending these trades, not unlike the multiple layers of security that you'll see in an important government building like the Pentagon. And the very first layer is our most basic one, which is the general risk management. In this layer, we're defining how much of our account that we can risk on this one trade. It's important that we perform this calculation before we enter the trade and not just arbitrarily slap on 10 contracts because we've always done it that way. And in the next layer up, on top of that earlier foundation, we'll add static risk management. What is our stop value at which we'll remove one of the credit spreads and roll it further out in distance? As you can see, high probability iron condors like this one have an unfavorable reward to risk ratio. This is what we're looking to earn, and this is how much is risking on the trade. So we have an unfavorable reward to risk ratio, and that means we can't tolerate a full loss on this strategy by letting the price expire inside or beyond the spread. If we did that, we'd end up losing several cycles of profits in just one trade. And on top of that foundation, we'll start to use our knowledge of the Greeks to determine how much dynamic risk we'll tolerate. How much value will the next point move up or down remove from our position? And are there any hedge positions that we can add to neutralize the risk? This is where you might have heard of the term delta neutral before. It's a big part of how we manage risk on positions dynamically. And speaking of dynamics, on top of this foundation of risk management, we add what I call dynamic risk management, which is to say that there are certain positions that we can add ahead of time that will dynamically grow in value to help defend against a deep attack on our credit spread positions. These are called my sleep at night positions that I place well in advance of an attack. And I finish off this stratified approach to risk management of the iron condor by adding what I call active risk management, which is more of a common sense approach to evaluate the potential reward of staying in the position longer versus the potential risk of additional market movement, and determine when it's time to pull the ripcord and close the position down for maximum profits compared to the risk. Okay, so with all of those things to think about, I've come up with a very targeted course to help your iron condor trading. We'll start out with advanced offensive techniques to give you as much edge as possible on the entry of the trade. Then we'll outline that stratified defense that I talked about, what actions to take and when to take them. We'll also get into the more professional, higher reward to risk iron condors that you might have seen before, as well as the tools and techniques necessary to show you how to professionally risk manage your options portfolio. This course provides 3 hours of video instruction that you can access immediately, including the session slides and a bonus chapter on how to apply the options Greeks to manage your portfolio.